Hey, hi everyone. Welcome back to the Advanced Mortgage and Insurance Solutions podcast. This podcast assists people with their property journey, whether you're a first home buyer or a seasoned investor, we cover all topics. I'm Joel Sadler, and our insurance expert today is Travis Hamilton, who works closely with Scott and the team from Advanced Mortgage Solutions. G'day, Travis. Welcome. So Travis is a financial advisor specializing in the health and insurance risk space. He's been in the industry for 15 years and is the country chair for a global financial advice organization called the $1 Million Round Table. Now, it's an interesting name, but it really focuses on assisting the top financial advisors from each country becoming the best they can when servicing their clients and delivering advice to their clients. In today's episode, we discuss mortgage protection. What is it? How does it work? And how is it different to other types of insurances? So look, Travis, do you want to kick us off by explaining what is mortgage insurance and how does it work?
So mortgage protection is a product basically designed to, if you're unable to work, to be able to cover your mortgage. So if you're unable to work due to any reason around your health, sickness, illness, accident, injury, it will provide you a monthly payment each month. And you can use that for your living cost, put towards your mortgage, etc. One of the common misconceptions around it is you actually need a mortgage to have it, which would make sense given the name, but it's actually based on a percentage of your income that you can cover. So whether or not you've got a mortgage or not, it will provide you a monthly payment and you can use that for living. And if you've got a mortgage, obviously that can help you with the repayments as well.
Ah, interesting. I didn't know that. When I think of that, it makes sense for me with a mortgage because I know what my monthly payment is. So I imagine I'd come to you and say, look, Travis, I'm paying, I don't know, let's just say $1,500 a month. I need to be able to cover that. If something happens to me, would that be the first kind of port of call that someone would ask you and to get moving forward?
One of the main questions we ask clients around that, we say, if you're unable to work due to sickness, illness, accident, injury, how long could you last without an income and what would you need? And mortgage is obviously a big component of that. You can actually cover up to 45% of your income if you're unable to work through mortgage protection. Very similar to another product called income protection, which is the same concept. Where they differ is mortgage protection is a bit more generous where it doesn't have what they call offsets for things like ACC, for example. So if someone has an accident and they're eligible for ACC, and they'll be receiving 80% of their income under that scenario, then mortgage protection will pay on top. So it's quite a good product in that regard. But if it's not an accident, like most people are off work, not always accident, it could be sickness, illness, then it's just the mortgage or income protection that they're relying on. Yeah, so it's kind of how they weave together.
Interesting. That's cool. So it's really designed, as you said, to take the pressure off per se in terms of, obviously it can't cover the full amount by the sound of it, but it's there to help top up and support people through that recovery period.
Absolutely. And one of the main things that when we talk to clients, a common answer that comes up is, especially if they've just taken out a home, for example, or a new mortgage, they're often in a high debt scenario where they've got a lot of responsibilities, etc. And we say, if you went off work, what would you want to have happen? And they normally figure out their own answer on that, but it's normally something like, we couldn't we wouldn't be able to continue to make our mortgage payments, or we couldn't be able to pay our bills, or so on and so forth. And they kind of identify that would be a problem. So then we'd look around what are the best options in that, cover it through mortgage protection as an example.
Yeah. Brilliant. So it almost sounds to me like what I've known as loss of income insurance. Would it be fair to say it's a similar thing or the same thing?
Absolutely. Basically is. And the names can be, as I mentioned, a bit confusing because the fact that it's based on a percentage of your income, not actually on your mortgage. You can actually just choose to cover it for the amount of your mortgage if you want, but it's actually, you don't just have to have the amount of your mortgage because there are other costs as well. So it's often called other things like, disability insurance, or we just call it mortgage income protection. And we just combine it. Most advisors that we meet use a combination of mortgage and income protection together. And why you'd use them separately is mortgage protection only covers you up to 45% of your income, which is not always adequate for people to live on. So we combine it with income protection to give them the best coverage possible. It's kind of the kind of the most common approach, I would say.
That makes sense. So if someone did say want to have the option of 100% cover each month, then they could work through that with you and have that hybrid model to achieve that.
So that, Joel, it's probably good to clarify that you can't you can't actually cover 100% of your income with any of the providers. And I guess maybe there's because there'll be lack of incentive to get back to work, although that would be great. You can cover up to 75% of your income through income and mortgage protection combined. So we try to get as close as we can to that number, but you can never actually quite fully cover the whole income if you're off work.
Yeah. Oh, that makes sense. And yeah, that incentive to get back to work makes a lot of sense as well. Yeah, so you can relax too much on the 100% cover. Yeah.
It's actually a lot of studies that actually identify that people are actually better off if they are able to work and going back to work, whether it's around their physical and mental health as well. So we do find that most people would prefer to be at work than not work. But you need to know that it's going to protect you if you can't work, right? And because it's private cover, you're not forced to go back to work prior to being ready, right? Because that's why you pay for the insurance side of things. So, you can have full faith that sometimes with the, whether it's ACC or the public sector, they would like you to return to work in a faster time frame. But, when you're ready and able, then that's how long it will cover you for, so to speak, when you're off.
Yeah. Yeah, that makes sense. Okay. And look, do you find, obviously working closely with Scott, and sometimes life insurance comes up, which I understand life insurance is if someone passes on, there's a lump sum left available to, say, cover the mortgage. We can come back to that in a minute. But do you ever find any scenarios where loss of income insurance or mortgage protection insurance is required by banks when people are lending at all? Or is it more just a recommended protection element?
Yeah. Wait, because it's not actually legally required to have the cover. It's implied that it's important. Sometimes there's a misconception that some people might come in and go, I believe I need to have this to get the mortgage and so on and so forth. And I'm really big at saying to clients, look, don't worry about, it's not what the bank thinks. It's not what the insurer thinks. It's not even what a financial advisor says you need. It's really about, I always bring it back to go, it's whether or not you would need that or want that. So we take them through the scenario, go, what would you want to have happen? And using the example you said about the life cover, if something were to happen to either of the clients, like pass away prematurely or diagnosed with a terminal illness, what would you want to have happen in that scenario? And, but quite often in the cases they might go, hey, I wouldn't want to leave, the debt to my spouse to cover, I wouldn't want to have that burden with them. Or if I was sick, I wouldn't want to be able to lose the house because we couldn't have an income to make our repayments. So therefore, that is an important option to look at. And can we look at those scenarios? So you kind of guide it by the client because it's really down to what they want and need. And I think our role as an advisor is to help provide the options or scenarios to help them make their own decisions. And we just kind of guide them through that. But ultimately, most people are in a position where they do need it. But it's best that they believe that themselves rather than that they're told they're or required they have to, which is not the case.
Yeah, that's really smart. So I have life insurance and then the trauma insurance as well. And the main driving factor for myself was, as you just said, I don't want to leave my wife, if I died, say tomorrow, get hit by a bus or whatever, I don't want to leave her with a mortgage that she has to all of a sudden try and pay, and I know banks have a certain element of grace, but I'm, in our relationship, I'm the main breadwinner, and that would be sort of throwing her under the bus, really, trying to afford, she'd probably have to sell,
Yep.
So it's nice and reassuring for me to know that, there's a lump sum there that's going to cover the mortgage and help her sort of transition into whatever she's going to do, well, she would do, is going to, but, whatever she might have to do, to keep her and the kids looked after. And I think you're right. And I think sometimes not everyone has the ability to think through those things. So I think it's really powerful meeting someone like yourself to help actually paint those scenarios and go, look, we hope this is never going to happen, but what if A, B, C, D, F happened? And then do you often see clients sort of the penny kind of drop, for want of a better word, that they may have never even considered some of these things before?
Absolutely. And I think biggest part of it. It is that the peace of mind, right? That's the main thing
Yeah.
because it's kind of a, if you insure your house or your car, you can touch it, right? You can see it.
Mm.
You're basically, you're insuring something that's intangible on a promise that they're going to look after you if and when you require it. So there's a bit of a, a leap of faith in that regard. And I always say to people, it's people often think, ask them what's their biggest asset, and they might say it's the house that they've just taken out, but it's actually their health or their ability to earn an income, to provide that ongoing income, which ends up to be a bigger number than the value of the house over the long term. So when people actually work that out, and why we're also quick to, all of us as self-employed, insure the car or the contents,
Yeah.
but not themselves, which is their biggest asset and their ongoing income. It's just kind of a switch of framing. And a lot of people say, I didn't know that some of these options are available, or what about ACC? Can I not just rely on that? The people are
Mm.
unaware that it's just for accident only, not your long-term sickness, illness, whether it's physical illness or mental illness as well. There's a big claim now with, levels of anxiety and stress and, people and self-employed people, for example.
Mm.
Those things, can I just rely on the public sector? And they can as well. It's not to say that you can't do that. It's just going, hey, this is what the public does. This is what private does. Some people think this, some people think that. Where are you on that scale? And it's not necessarily for everyone. Like an example could be, I could have a 28-year-old male or female on their own, bought their own house, no partner, no kids. And they say, hey, if something happened to me, if I was to pass away, I guess the house would sell and the equity would clear the debt, and there's nothing really that's not that important to me. But what is important is if I can't work, to be able to pay my mortgage, and that's your mortgage and income protection that we're referring to. So there's no right or wrong. I always say to people, there's a whole spectrum or a level of different scenarios, and it's got to be unique and tailored to everyone's individual needs and requirements. And I think it's our job to help them figure that out.
Yeah. Yeah. Brilliant. And tell us, are there any recent examples that you could share? Obviously, names redacted and all that around where you've seen a client or assisted a client with that mortgage protection element.
I'd say we've probably got, just looking at the office, probably 3 or 4 cases on the go at the moment. Actually,
Right.
we've had mental health, as I mentioned before, is one
Yep.
that we see a bit, and that's a growing globally, growing sort of trend.
Mm.
A lot of them fall under musculoskeletal, which basically means something physical, whether it's muscles, joints, bones. We, in terms of, we've got someone that's on claim for lower back pain at the moment, and the mortgage protection helps top up what they can get from ACC.
Nice.
We've got a few that aren't eligible for ACC because it's not an accident, and they're on the mortgage and income protection combo as well.
Mm.
Just thinking of a recent example, we've had anyone from carpal tunnel syndrome at the moment to stress leave, to a chronic bowel condition with another client. So yeah, and it pays you. It's interesting to see how long it pays you for, right? So as I mentioned, it pays you until you
Yeah.
go back to work, but there's kind of some different options because it's got to be affordable and fit within a budget. So there's no point having it otherwise because people might not retain it. So, it can pay you all the way through to age 65 or 70, which is, retirement age for a lot of people, or you can have a shorter period where it only pays you for a 5-year period if you're off work, or 2 years. They're the main options. Now, the shorter the benefit period, the cheaper or more affordable to cover. So it's better to have something than nothing. You might think, well, if I'm 30 years old, I've got a 2-year benefit period. That would only put me through to 32 compared to 65. I've got a big gap there, which is true. But most claims, the majority of people are back to work between, 2 to 5 years. Some providers, the average claims about a year. So most of the time, you will actually fit within that timeline anyway, and it won't impact you. But if that's the trade-off you make, right? If you are off work longer than 2 or 5 years, chances are it's a long-term claim, and it's just a trade-off with cost, like anything, right? And it's
Yeah.
everyone has to. We all have to trade things off to fit within a budget and be affordable, right? But you just help people work that out, Mm.
Yeah. Yeah. That's great. That was going to be one of my questions is, does it cover a short period or a long period? And you've answered that beautifully. So the way, just reflecting that back, you have the option, a cheaper level, sort of that shorter 1 to 2 year period, or you can go the whole hog up to say 65, for example. And obviously you're paying a lot more because it's a longer protection time or period. Yeah.
Part around that is you can pick how quickly it kicks in as well. It's called the waiting period, how long before it kicks in. And there is a vast array of different options, but generally the 1 month, 2 month, or 3 month before it kicks in are the options. And they have a significant difference, like a 3 month wait. So that's obviously for something a bit more long term, like a bit more serious, because that's about half the premium though of someone on a 1 month wait. And that can be a significant saving for people, right? So you just help people work out the wait benefit period options and show them how in a table how that affects things, and they can arrive at something that they're comfortable with from that.
Yeah, and look, that makes sense too. If some people have savings, or they know that they've got a certain amount of runway, in their belt or savings to carry them through, they might go for that, that slower or that delayed period, which makes sense, keeps the premium cheaper. Yeah, interesting. Yeah, brilliant. All right, Travis, it's been really interesting. Are there any sort of final tips or points for our listeners that you'd make or recommend around mortgage protection if they're considering it?
Yeah. Probably a tip would be make an informed decision regardless of whether or not you have it or not. Just don't, it's good to be aware so you can decide whether or not it's relevant or for yourself. It's good to seek advice from a qualified financial advisor to help you guide your decision making. But ultimately, at least be aware of the scenario. And probably the main question I ask people in that scenario, which is you can tell they haven't really given it much thought previously, which is if you are unable to work as of today, if you went off work today due to sickness, illness, injury, how long could you last without an income? What would you want to have happen? And what would be the plan B? What would be the next step? And often they have to really think it through, and that's good because it means that they're digesting and what they'll do in that scenario, and hopefully helping them just make an informed decision about what they would do. And that's probably the most important thing. And whether or not they take cover out or not, at least they're aware. So that would be where I'd start.
Yeah, brilliant. All right, thanks, Travis. For our listeners, anyone that's wanting to get in touch with Travis, you can go to www.advancedmortgagesolutions.co.nz. There's information there about insurance policies, including mortgage protection insurance. There's web forms. You can get in touch with the team and reach out to Travis to book an appointment. Travis, just one thing I want to cover off is, do you charge upfront fees for appointments?
Most advisors, myself included, we don't charge any fee for advice. We have a disclosure that we give to clients, and it says how we're remunerated. And it's essentially very similar to the mortgage world. We get remunerated in the form of a commission if a client proceeds with the policy. We're non-aligned, so we deal with a lot of the main providers in the market. So we try to give full holistic advice in that space, with comparing different options. And if and when we do get paid a commission, we disclose that level to the client. So there's just that that transparency. But because that's how we get remunerated, it basically means we don't have to charge any fee for advice because we're compensated anyway. So hopefully it's a low cost to advice for the clients in that space, which is great.
Brilliant. Awesome. All right, Travis, thanks for your time today, and we'll see you on the next episode.
Thanks, Joel. Thanks for having me.